Trading effectively using Elliott wave theory. You are welcome in Elliott wave FX. For decades, traders have searched for order within the apparent chaos of the financial markets. While fundamental analysis looks at the why of price movement and traditional technical analysis focuses on the what, Elliott wave theory provides a unique window into the when and how. Developed by Ralph Nelson Elliott in the 1930s, this methodology proposes that financial markets do not move in a random walk. Instead, they move in repetitive, cyclical patterns driven by the underlying, shifting tides of collective human psychology, alternating between bouts of optimism, greed, and pessimism, fear. To trade effectively using Elliott wave, you must move past treating it as a rigid academic exercise. It is not about forcing the market to fit a perfect textbook pattern. Rather, it is about using wave structures as a GPS to map market cycles, identify high-probability turning points, and manage risk with mathematical precision. 1. The anatomy of the market cycle. At its core, Elliott wave theory states that a trending market moves in a repeating 8-wave cycle, a 5-wave motive, or impulse, phase that moves in the direction of the primary trend, followed by a 3-wave corrective phase that retraces a portion of those gains. As illustrated in the diagram above, the cycle breaks down into distinct behavioral waves. Wave 1, impulse, a preliminary move up, often starting from a point of extreme market pessimism. It is typically small and overlooked by the broader public. Wave 2, correction, a sharp sell-off as early buyers take profits and late bears try to push the price back down. However, it fails to make a new low. Wave 3, impulse, the strongest, longest, and most explosive wave. Optimism takes over, fundamentals improve, and the broader market climbs on heavy volume. Wave 4, correction, a profit-taking consolidation phase. It is often complex, sideways, and range-bound. Wave 5, impulse, the final push driven by retail FOMO, fear of missing out. While prices make new highs, momentum often starts to diverge. Waves A, B, and C, correction, the corrective counter-trend that unwinds the excesses of the entire 5-wave advance. The 3 cardinal rules. Before you can trade this structure, you must memorize the 3 non-negotiable rules of impulse waves. If any of these rules are broken, your wave count is invalid, and you must relabel your chart. Rule 1. Wave 2 can never retrace more than $100% of Wave 1. If it breaks the origin of Wave 1, the count is invalidated. Rule 2. Wave 3 is never the shortest wave among the 3 active impulse waves, waves 1, 3, and 5. It is usually the longest. Rule 3. Wave 4 can never enter the price territory of Wave 1, meaning the bottom of Wave 4 cannot overlap with the top of Wave 1, except in rare diagonal structures. 2. Integrating Fibonacci levels for precision entries. A wave count tells you where you are in the market cycle, but Fibonacci ratios tell you exactly where to expect the market to turn. Elliott discovered that the proportions of these waves naturally conform to Fibonacci ratios, specifically. When trading, you can use these key ratios to project targets and identify entry zones. Wave 2 pullback targets. Wave 2 is a deep retracement that shakes out weak-handed buyers. It typically retraces to the 50.0% to 61.8% Fibonacci level of Wave 1. Trading tip: if you see a clean 5-wave move up, Wave 1, followed by a slow, 3-wave corrective pullback right into the 61.8% golden pocket, you have a high probability zone to hunt for long setups. Wave 3 expansion targets. Because Wave 3 is usually the strongest impulse, its target is projected using Fibonacci expansions. The standard target is, this expansion is projected from the bottom of Wave 2. If momentum is incredibly strong, Wave 3 can extend to or even times the length of Wave 1. Wave 4 pullback targets. Unlike Wave 2, Wave 4 is typically a shallow, sideways correction because the market is highly bullish and eager to buy dips. It usually retraces only occasionally just of Wave 3. 3. High probability trading strategies. Knowing the theory is one thing, executing trades and managing risk is another. Let's break down two of the most robust, actionable setups using Elliott Wave. Strategy A, buying the Wave 3 launchpad, the golden setup. The goal of this strategy is to enter at the transition from Wave 2 to Wave 3, capturing the fastest and most profitable move in the entire cycle. Step-by-step execution: identify Wave 1, look for a sharp, impulsive 5-wave move off a major swing low. Wait for the correction, let Wave 2 unfold. It should look choppy and sluggish, a corrective structure, rather than sharp and aggressive. Locate the entry zone, draw a Fibonacci retracement from the start of Wave 1 to its peak. Highlight the zone. Confirm the turn, zoom in to a lower time frame, e.g. if you are on a daily chart, drop down to the 4-hour or 1-hour chart. Look for a minor 5-wave impulse starting to form off the Fibonacci support. Place the entry and stop loss, conservative entry, by the moment the price breaks above the swing high of Wave 1. Aggressive entry, buy inside the golden pocket once lower timeframe structure shifts bullish. Stop loss, place your stop loss strictly below the bottom of Wave 2. If the price drops below this level, Rule 1 is broken, your thesis is proven wrong, and you exit with a small, controlled loss. Take profit, set your first target at the Fibonacci expansion of Wave 1. Strategy B, trading the Wave 5 reversal with divergence. This strategy focuses on shorting the end of an exhausted uptrend, or buying the end of a downtrend, at the terminal point of Wave 5. Step-by-step execution: count the waves, ensure you have a clearly defined Wave 3 and a completed Wave 4 pullback. Project the target: Wave 5 is frequently equal in length to Wave 1, or $61.8% of the distance from the start of Wave 1 to the end of Wave 3. Use these levels to highlight a potential reversal zone. Monitor momentum: pull up a momentum oscillator like the RSI, Relative Strength Index, or MACD. Identify bearish divergence: as the price pushes up to make a new high in Wave 5, higher than the peak of Wave 3, the RSI should print a lower high. This indicates that while the price is rising, the buying pressure is rapidly dying out. Execution: once the bearish divergence is confirmed and you see a reversal candlestick pattern, e.g. a bearish engulfing candle, on key Fibonacci resistance, enter a short position. Stop loss: place it slightly above the newly formed Wave 5 high. Take profit: target the Wave 4 territory of the previous impulse, which is the natural magnet for the ensuing ABC correction. 4. Common pitfalls and how to avoid them. While incredibly powerful, Elliott Wave is often criticized for being subjective. Two traders can look at the exact same chart and draw two completely different wave counts. To keep your counts objective and highly effective, avoid these common mistakes. Avoid forced counting. The biggest trap is trying to force a messy chart into a perfect Elliott Wave structure because you have a bias about where you want the market to go. If a chart looks like sideways noise, do not trade it. Elliott Wave is best applied to clear, liquid markets with strong trend participation, such as major indices, high-volume FX pairs, and highly traded commodities. Always match your time frames, the fractal nature. Waves are nested inside waves. A 5-wave move on a 15-minute chart is simply the internal structure of Wave 1 on a 4-hour chart. To trade effectively, always perform a top-down analysis. Start on the weekly/daily charts to find the dominant macro wave direction. Drop down to the 4-hour/1-hour charts to map the current subwaves. Use the 15-minute/5-minute charts to pinpoint your execution triggers. Treat validation and invalidation as your best friends. Every trade setup must have a defined invalidation point. The beauty of Elliott Wave is that its structural rules tell you exactly when you are wrong. If you buy a Wave 2 pullback, and the price invalidates the count by dipping below the origin of Wave 1, take the loss immediately. Capital preservation is what allows you to stay in the game for the highly profitable Wave 3 moves. Summary cheat sheet. Common Fibonacci target. Ideal action. Wave 1. Impulsive. Starts the cycle. Observe and wait for structure to form. Wave 2. Corrective. Hunt for long entries with stops below Wave 1 origin. Wave 3. Impulsive. Hold for the major target, add to positions on breakouts. Wave 4. Corrective. Tighten stops on remaining positions, wait for range play. Wave 5. Impulsive. Look to take profit, search for divergence to trade reversals. By treating Elliott wave theory not as a crystal ball, but as a framework for managing probability and risk, you can align yourself with market sentiment and execute trades with absolute structural clarity.